This month, something inside Social Security shifted, and most folks never got the kind of notice they really needed. Not in plain language, not up front, and definitely not in a way that spells out what it means for your finances. And that's the issue. This update is already changing checks, already altering what certain people are paid, and for some it can be the line between funds hitting your account or quietly getting lost in the background without you ever noticing. Because while the news cycle highlighted a modest bump, a much larger change was unfolding out of view. And if you don't know what to watch for, you could miss money you're entitled to, or even see part of what you expected reduced without realizing why. Over the next few minutes, I'll show you what changed, why it matters right now, and the exact areas where retirees are either coming out ahead or unknowingly handing money back. Hi, I'm Susan Harper, and I focus on turning complicated Social Security and retirement updates into clear, real-world guidance you can actually use. I'm not here to bury you in confusing terms or fuzzy headlines. I'm here to explain what's happening, what it does to your monthly income, and what you can do about it right away. Because at the moment, there's a widening gap between what people believe they'll receive from Social Security and what actually ends up deposited. And inside that gap is where thousands of dollars can quietly drain away over time if nobody calls it out. So let's begin with the one figure everyone keeps hearing about, the cost of living adjustment. On the surface, it sounds positive, but once you unpack it, the story looks very different. The 2025 COLA was set at 2.5%. On paper, that sounds like a win. It sounds like benefits are staying aligned, like the program is doing what it's meant to do, raising income so you can handle higher prices. And technically, yes, the monthly benefit did go up. For the typical retiree, it's roughly about $50 more each month, maybe a little higher depending on your details. Across a full year, that's about $600. If two people in a household both get benefits, the combined change could reach $200 or more. So at first glance, it feels like forward movement, it feels like breathing room. But here's where it starts to get messy, because that 2.5% is built on a measurement that doesn't fully match how retirees actually spend. It's tied to the Consumer Price Index, a broad inflation measure across the entire economy. The problem isn't that the index is wrong, it's that it's too broad. It assumes spending patterns as if everyone lives the same financial life. But retirees deal with a very different cost structure. Think about what you truly spend on each month. Housing, whether that's rent, property taxes, or repairs. Healthcare, which usually rises with age. Prescription drugs, insurance costs, utilities. These aren't side expenses. They're the foundation of most budgets, and in recent years, those exact categories have been among the fastest climbers. So when you hear 2.5%, it may represent a blended average, including everything from electronics to clothing to transportation, but it doesn't mirror your world. It doesn't capture that your grocery run may feel 10% higher, that insurance jumped sharply, right? Or that one medication change can throw your whole month off. That's the disconnect. The system says your income rose enough to keep up, but your everyday experience tells another story. And that gap, the space between official figures and real living costs, is where many retirees feel like they're sliding backward, even while their benefit technically increases. Now, here's the piece that's easy to miss. Even that small-looking boost, the $50 a month that seems helpful, doesn't necessarily stay with you. Because before the extra money ever reaches your bank, other pieces can quietly pull from it. Adjustments, premiums, and deductions running in the background. So while the headline says more, the reality is you may only keep part of it, or in some cases feel almost none of it. And this is where a simple change in perspective becomes critical. Rather than fixating on how much your benefit rose, start watching how much actually lands in your account after deductions. That's the real figure. That's the number that drives your flexibility, your stability, and your everyday choices. And if this kind of plain breakdown helps you, if you want clear updates on the changes that truly affect your income, make sure you stay with me, because these updates keep coming. And the people who stay informed are the ones who keep control of their retirement. Now with that foundation, let's move into the part nearly nobody was discussing, while COLA grabbed the spotlight. Because behind the scenes, a major rule flipped in a way that can put serious money back into the hands of millions. While most attention stayed fixed on the 2.5% increase, something far bigger was moving quietly in the background. It doesn't apply to everyone, but for those it does, the impact is enormous. For decades, two rules inside Social Security have silently lowered benefits for a specific group of retirees. Not because they didn't earn the money, and not because they did anything wrong, but because of how the system was built. Those rules are the Windfall Elimination Provision, WEP, and the Government Pension Offset, often called GO. And unless they've hit you personally, there's a good chance you've never even heard those terms. Here's what it looked like in real life. Picture someone who spent a big part of their working years in a public job. A teacher, firefighter, police officer, or city employee. In many of those jobs, the worker paid into a state or local pension plan instead of Social Security. But at some stage, they also held other work, maybe earlier, maybe part-time, maybe seasonal, where they did pay Social Security taxes. They earned credits. They paid in. They qualified like anyone else. Naturally, when retirement arrived, they expected to receive both. The pension earned through public service and the Social Security benefit earned from the other work. But that's not how the system treated them. Under WEP, the benefit formula was altered in a way that reduced their Social Security payment, often not by a little, but by hundreds of dollars each month. And it wasn't because they were collecting extra money they didn't deserve. It was because the system labeled the situation a windfall, even though it came from real work and real contributions. The calculation changed, and the check dropped. For many, it felt like punishment for choosing public service. Then the government pension offset pushed it even further. That one hit spousal and survivor benefits. So if a spouse worked in the private sector and paid into Social Security their whole career, that spouse would usually qualify for spousal benefits or survivor benefits. But if the other partner had a government pension from a job that didn't pay into Social Security, the GO could reduce or wipe out that benefit. In some cases, it erased it completely. That meant widows and widowers who expected at least some stability after losing a spouse suddenly received nothing from that part of the system. When you step back, it's easy to see why this created years of anger. Millions were impacted. People who worked, contributed, planned, and still ended up with less than they were led to expect. And for a long time, there wasn't a real fix. It became one of those topics people argued about, pushed for, and demanded change on. But nothing moved. Until now. Because what's happening right now is a true turning point. WEP and GO have officially been eliminated. Not softened, not tweaked, not slowly phased out. Eliminated. That means the formulas that once reduced benefits for millions are no longer active. And for those who were affected, this isn't just a policy headline. It's a financial correction. It means benefits are being recalculated to what they should have been. It means monthly checks rising, sometimes by hundreds of dollars. And for many households, it means something even larger, retroactive payments. That's where attention really spikes. Because when a rule like this is removed, it doesn't only change future checks. It can also create back pay for money that was effectively held back under the old rules. Depending on how long the reduction applied and how large it was, those retroactive totals can climb quickly. We're talking thousands of dollars in some cases, sometimes much more. And here's the key. This isn't a hypothetical. It's already underway, and a major wave of recalculations and payments is expected around this time period. But there's a catch, and it matters. Not everyone who qualifies realizes they qualify. Many people accepted their benefit amount years ago without fully understanding how it was computed. They saw the figure, assumed it was correct, and moved on. So right now, there are retirees who may qualify for higher ongoing checks, or even retroactive money, and they don't know to look, they don't know to ask. And in a system this large, the people who take an extra step, verify, call, follow up, are often the ones who see results sooner. This is where we move from awareness into action. Because even if you aren't sure whether WEP or GO ever touched your case, there are clear clues and specific steps you can take to find out. We'll go through those shortly so you're not guessing. But before we do, there's another part of this that affects almost everyone receiving Social Security. something that quietly lowers your deposit every month and often rises over time whether you notice it or not. So now that these provisions are gone, the obvious question is, what does that look like in real dollars? What changes for the people who were hit by them? In many cases, it's major because once those reductions are removed, Social Security recalculates your benefit using the standard formula. No penalty math, no special adjustment, just what you earned based on your work record. And for many retirees, that means a noticeable jump is coming. Some will see about $200 more per month. Others may see $400, $500, or even more depending on the size and length of the reduction. But the monthly bump is only one part. The piece drawing the most attention right now is the retroactive money. Because if your benefit was reduced for months or years under WEP or GO, that difference doesn't vanish. It gets added up and repaid, and that's where you hear standout totals. $5,000, $8,000, $10,000 or more, depending on the details. This is money that was always yours based on your work and your contributions. It was simply calculated under a rule that no longer exists. And now that the rule is gone, the system is correcting it and often paying it out. Timing is important, which is why May has become such a key window. The Social Security Administration has been working through millions of records, recalculating benefits, confirming eligibility, and processing updates. It's not happening in one instant, it's rolling out in waves. And this period marks a major push where many of those changes are expected to show up, either as bigger monthly deposits or as lump sum retroactive payments. So if your deposit amount shifts, or you see an additional payment you didn't anticipate, this may be exactly why. Now let's talk about who needs to pay close attention, because while it doesn't hit everyone, the affected group is bigger than most people think. If you worked at any point in a job where you did not pay Social Security taxes, again, many teaching roles, law enforcement, firefighting, and certain government jobs, take a closer look. If you changed careers and paid into both systems, this matters to you. If your spouse had that kind of work history and you're receiving or expecting spousal or survivor benefits, this matters to you too. And here's where urgency comes in. Not everyone will be notified in a clear way that truly explains what changed. Some will see the increase and instantly understand. Others may receive money and have no idea why. And some won't notice anything yet, not because they don't qualify, but because their case hasn't been fully processed, or because they never questioned the original calculation in the first place. That uncertainty is exactly why you should be more hands-on right now. Because in a system managing millions of updates, the people who check, confirm, and follow up often move faster. So, even if you're only partly unsure, if there's even a possibility your work history or your spouse's included a pension-based job that didn't pay into Social Security, it's worth investigating. This is one of those moments where a little effort can become a real financial change, both in what you get going forward and what you may still be owed from the past. And in just a moment, I'll walk you through how to check and what to do so you aren't stuck guessing. But before that, we need to shift to something that impacts nearly everyone collecting Social Security, no matter what they did for work. Something already reducing your monthly benefit right now and quietly rising year after year. Because even if you gain in one area, another system can pull that gain back out before you ever feel it. That system is Medicare, specifically Medicare Part B. For most retirees, this is where a chunk of your Social Security check disappears each month with very little attention. It's automatic. The premium is deducted before the payment hits your bank, meaning the deposit you see is already smaller. And when that premium rises, as it just did, it directly determines how much of your COLA you actually keep. In 2025, the standard Medicare Part B premium increased to $180 per month, up from $470 the year before. That's a $1,030 monthly increase, or roughly $123 across the year. Now think back to that COLA. For many, it added about $50 a month. But before you ever feel the full $50, Medicare has already taken part back. So instead of experiencing a $50 bump, it can feel more like $40 or less depending on your situation. And that assumes you only pay the standard premium, because for many retirees, the amount being deducted is much higher. This is where it gets less obvious and far more costly, because beyond the base premium, there's another layer that doesn't get talked about nearly enough, but can drastically raise what you pay. It's called IRMAA, the Income-Related Monthly Adjustment Amount. The name is complicated, but the idea is simple. If your income is above certain levels, Medicare adds a surcharge on top of the standard Part B premium. The more income you have, the larger the surcharge. But here's what blindsides people. Medicare doesn't decide this using what you earn today. It looks back 2 years, so in 2025, your premium is based on your 2023 income. That detail alone creates a lot of confusion and a lot of surprise bills. Here's what happens. Someone might have had one unusually high income year. Maybe they sold a home, took a larger retirement withdrawal, or had investment gains. On paper, that year looks elevated, but it doesn't represent their long-term reality. Still, Medicare uses that snapshot and charges higher premiums for the next 2 years, as if that higher income continues. So even if your income has dropped sharply since, maybe you fully retired, cut hours, or no longer have one-time gains, you could still be paying hundreds more per month than needed, and the range is big. In higher brackets, Medicare Part B can rise well beyond $600 per month. That's not minor. That's thousands per year coming directly out of what would otherwise be your Social Security income. And what makes it more aggravating is that many people don't know why it's happening. They see the bigger deduction, assume it's normal, and move on. Or they believe once Medicare sets it, it's permanent and they have no option. That belief is where unnecessary overpayments quietly accumulate, because in reality, you can challenge it. You can update the income determination if it no longer matches your current situation. And most people are never clearly told that option exists, so it goes unused. But for those who do use it, the change can be fast and meaningful. We're talking about dropping premiums by hundreds each month just by getting Medicare to use your current income instead of an outdated snapshot. And in the next section, I'm going to show you how that works, who qualifies, what form you need, and how people are using it right now to bring Medicare costs back down to what they should be. Because this is one of those rare situations where a fairly simple step can create a real, ongoing increase in what you keep every month. The way to fix that Medicare surcharge is through a life-changing event appeal. And this is where a lot of people are losing money, simply because they don't realize they're eligible. Medicare lets you request a lower premium when your current income is lower than the 2-year-old tax return they're using, but you have to start it. It won't happen automatically, and no one will reach out to recommend it. You have to recognize the mismatch and act. The form that makes this possible is SSA 44, and it's built specifically for cases where your financial situation has changed in a significant way. So what counts as a life-changing event? Things like retiring or reducing hours, losing income-producing property, divorce, or the death of a spouse. Basically, any event that drops your income compared with that earlier tax year. When that happens, you can ask Medicare to base your premium on what you earn now, not the outdated figure. The steps are straightforward. Complete SSA 44, provide documentation showing the change in income, submit it for review, and once approved, your premium can be lowered, sometimes by a lot. And this isn't a tiny adjustment. There are real examples where someone was paying $400 or more each month for Part B, filed the appeal, and saw it drop back to the standard $185. That's over $200 monthly in savings, more than $2,500 over a year, money that stays with you instead of being deducted from your Social Security. For someone on a fixed income, that's not just nice. It can reshape how manageable the month feels. And the only difference between the people who keep that money and the people who don't is awareness. One group knows the option exists and uses it. The other assumes the number is final. So, if you're paying more than the standard Part B amount, this is the time to pause and ask one simple question. Does my current income really match what I earned 2 years ago? If the answer is no, there's a good chance you're paying too much. Once you see that, the next move is obvious. This is one of the few places in the system where you can directly affect the outcome in a fairly short time. It's not about waiting for lawmakers or hoping someone fixes it. It's using a process that already exists to correct something that's out of it. And there's one more piece that surprises retirees year after year, often at the worst time, when tax season arrives and they discover some of their Social Security may be taxable. In the next section, we'll lay that out clearly because understanding it and preparing can prevent an unpleasant bill. That surprise tends to show up when you file taxes, and it catches many retirees off guard because it doesn't feel logical. After decades of paying in, watching taxes come out of every paycheck, it's easy to assume Social Security benefits would arrive without another tax layer. But that isn't always how it works. Whether benefits are taxed and how much depends on something called combined income. Once you understand what that is, it becomes clear why so many people owe more than expected. Combined income includes your adjusted gross income, any non-taxable interest, and half of your Social Security benefits. Add those together, and the total determines whether part of your benefits becomes taxable. If that total exceeds $25,000 for an individual or $32,000 for married filing jointly, up to 50% of benefits may be taxed. If it goes above $34,000 individually or $44,000 for a couple, up to 85% of benefits can be subject to federal income tax. And here's what many people overlook. Those thresholds haven't been meaningfully updated in decades. They were set long ago and left there even as costs rose and benefit amounts increased. In real life, that means more retirees cross those lines each year without doing anything dramatic. Benefits rise slightly with COLA. Maybe you take a modest retirement withdrawal. Maybe you earn a little extra. Suddenly you're above the threshold, not because you became rich, but because the system didn't keep pace with inflation. Once you cross it, your tax situation can change in a way that feels abrupt. You go from expecting little or no tax on benefits to realizing a large portion is now taxable. The goal isn't only knowing this exists, it's planning ahead. Because once you understand combined income, you can make smarter choices about when and how you pull from other income sources. Small changes can determine whether you stay under a line or move into a higher taxable range. It's not always avoidable, but it is forecastable, and that predictability gives you control. Without awareness, it feels like a hit out of nowhere. With awareness, it becomes part of your plan. So when you take a step back and look at what we've covered, the COLA that doesn't fully match real expenses, the end of WEP and GO that can raise benefits and trigger back pay, Medicare premiums that quietly reduce deposits, IRMAA surcharges based on older income, the earnings limit for working retirees, and the taxation of benefits. You start to see the pattern. It's not only about what Social Security pays, it's about how many separate forces determine what you actually keep. Once you see that, the next step is clear. Taking action so each part of your benefit works for you. So here's what I want you to do starting this week, while these changes are current and relevant. First, sign into your My Social Security account at ssa.gov. If you don't have one, create it. It takes only a few minutes and it gives you direct access to your earnings record and benefit information. Once inside, review your history closely. Your benefit is based on your highest 35 years of earnings. If a year is missing or an amount looks wrong, it can lower your benefit without you realizing. If you see errors, report them and get them fixed. Second, if there's any chance WEP or the government pension offset affected you through your own work history or your spouse's, contact the Social Security Administration directly. Call, ask, confirm. With the provisions eliminated, you want to be sure your benefit was recalculated correctly and that you aren't missing a higher check or a retroactive payment already in motion. Third, review your Medicare Part B premium carefully. If you're paying more than the standard amount and your income changed since 2023, download the SSA-4 form and begin the appeal. This is one of the most direct ways to lower a recurring cost that comes out of your Social Security every month. It's practical, and the payoff is real. Fourth, if you're working while collecting benefits, estimate your yearly earnings and compare them to the earnings limit. Know your position so you can avoid unexpected reductions, or at least understand exactly why they occur. And finally, keep taxes in mind all year. Don't wait until filing season to learn how your benefits will be taxed. A bit of planning now can prevent a much bigger shock later. Because when you boil this down, it comes to one simple idea. This is your money. You earned it through decades of work, paying in and showing up. And while the system has rules and complexity, you have more influence than it seems at first. Which one you experience depends largely on whether you act. Because the truth is, the system doesn't automatically optimize itself for you. It processes data, it applies formulas, it moves on. But it doesn't stop to ask whether your income changed recently. It doesn't double-check whether an old rule unfairly lowered your check unless the update reaches your file. It doesn't warn you before you cross a tax line or trigger a higher Medicare premium. That requires your attention. And once you have that awareness, your decisions, even small ones, start to matter. For some, it's one phone call to confirm their benefit was recalculated after WEP or GO ended. For others, it's submitting one form to drop a Medicare premium to match their current income. For someone still working, it may mean a small scheduling change to stay under a limit and avoid unnecessary withholding. And for many, it's simply reviewing records for the first time in years and catching something that slipped by. None of these actions are complicated, but together they can make a meaningful difference in what you keep, not only this month, but throughout retirement. And that's the larger point. This isn't about chasing every headline or reacting to one update at a time. It's about understanding the system well enough that it doesn't catch you off guard. It's about moving from a passive role, accepting whatever shows up, to an active one where you verify, adjust, and make sure the numbers match your reality. Once you do that, the whole system becomes more predictable. And when changes happen like they just did, you can respond quickly instead of scrambling afterward. So, as we move forward, hold that mindset. Check your amounts, follow up when needed, use the changes that help you, and correct the ones that hurt you. Because every dollar you keep is the result of understanding how these parts fit together and taking the time to act on what you know. You already did the hardest part. You worked for these benefits over a lifetime. Now the goal is making sure you actually receive everything you're entitled to with nothing slipping by unnoticed.